Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How are you doing today? What a wild ride in the markets lately, huh? It's just incredible. Well, a lot of times what people can do is when you see the markets getting volatile, you forget all the other rules, the strategies, planning, all that great stuff. I need to keep you updated on that so we all get it, that the markets, they're crazy and going nuts right now. Hopefully you have the right investments, you've allocated the way that's fitting your goal and everything. But I listen for mistakes that people are making, and I see a mistake with the traditional IRA. So I want to bring this to your attention because it creates, it's not only like a mistake initially, but it creates a mess down the road. So please, if you have a traditional IRA, stick with me. I'll make this super simple and quick for you. Okay, you hear me all the time talk about the Roth IRA, and if you make too much money, you can't contribute. Like if you're married filing jointly and your adjusted gross income is over $206,000, you actually can't contribute to a Roth IRA. Well, that's usually the numbers that everybody focuses on. But in the traditional IRA, most people think there's no limit. I can make as much as I want and still put money in the traditional IRA. That's true, but stick with me for a second. So here's how this works. In a traditional IRA, they break it down just like the Roth IRA. You got single, married filing jointly, married filing separately, okay? Now, the rule here is, yes, you can make as much as you like and you can contribute to a traditional IRA. There are no income limits on it. However, here's how the IRS says this. If you are covered by a 401k plan at work, or if you have a workplace retirement plan, then we're going to look at your income to see if you can deduct the traditional IRA contributions, right? What this basically means is, you know how in a traditional IRA, you can contribute $6,000 for 2020 or $7,000 if you're over the age of 50, and then you go do your taxes and you say, oh, I'd like my tax credit for that, right? Because that's supposed to be pre-tax money. You put in money from your bank account, which has already been taxed, you into your IRA, the government says, oh, you put it in a traditional IRA, we'll credit you back for the tax that you paid there, and in exchange, in the future when you retire, you will then pay tax on that money. However, if you are covered by a 401k plan at work, not if you participate, if you are simply covered by one, meaning it's there and available for you, don't let that little fine print get you in the way there, then they look at your income. So the way this works is if you are single, it's $65,000 to $75,000, married filing jointly $104,000 to $124,000, and greater than $10,000 if married filing separately. So if you have a traditional IRA, you're putting money in, and you are covered by a 401k plan at work, and you're single, and your adjusted gross income is over $75,000, you will get no deduction for putting money in. Now, if you're in between the 65 and 75, you'll get a partial deduction. It just depends on where you land, right? If you're married filing jointly and you make more than $124,000, or your adjusted gross income, sorry, not your salary, I always get that question, then you'll get no deduction for putting money in a traditional IRA as you expected. And if you're married filing separately and you're actually still together, that's the key word there, then you get no deduction. If you're married filing separately and you truly are separate, that's a different story, but that's where you stand there in the traditional IRA. So be very careful with this because number one, the key word is if you are covered at work, not if you're participating in the 401k, and then go look at your adjusted gross income. Now, what does it matter? You put in some money in a traditional IRA, let's say they don't give you the deduction, you made too much there, what does it matter? It matters a lot because it creates a big mess down the road, and this is where people come to me and they're usually like, Dustin, I've been watching you for a while, I was doing my own thing, but now I'm in trouble and I'd like to hire you, I want to work with you, so here, take this account and fix it for me. We get a lot of that. Anyways, let's dive into what's going on here. Let's say that you are married filing jointly and you make too much money this year. You put $6,000 in your IRA, right? And you just go about your business. You file your taxes and you get no deduction. What happens? That money is now technically post-tax because the money you put in came from your bank account, which means it initially came from your check. So when you got paid, they took taxes out of your money, they put the money in your bank account. You then put the money in the traditional IRA, and what is the government going to say? When you get to retirement, they're going to tax you. Wait a minute, you've been taxed twice now on this money. That's not fair. So let's say you put that money in there and you don't move it. The next year, this is 2020. Now let's say we're in 2021. You put in $6,000 and your income is only $100,000, or your adjusted gross income is only $100,000. So let's say you got $100,000 AGI in this year. That's deductible, right? You're going to get the tax money back for that one. Now what happens? You got a total of $12,000 in there. That money has already been taxed. This money has not been taxed yet because you got your deduction from the government. So what happens? You go, well, that sucks. Let me take this money and move it to a Roth, right? Because a Roth is all post-tax. I've already paid tax. Let me move it over to the Roth. That way there's no confusion, and in the future I won't owe any tax. The IRS says, wait a minute. Have you read our rules? You're actually not allowed to do that. You are not allowed to go into your IRA and hand-pick the deposits that you want to move. Did you know that? You actually have to use the total balance. You have $12,000 in there now, assuming you never invested it, it didn't grow or fall in value. So now the IRS says, well, okay, if you're telling us $6,000 is post-tax, we see we didn't give you the deduction, you didn't qualify, and this is pre-tax because you did qualify for the deduction. The IRS says you actually have to take whatever the amount is and divide it into your total balance, which means you can't say I want this $6,000 to come out. You have to say I have $12,000, and of all $12,000, I'd like to take $6,000 out. That is 50% of the value of your IRA if you take $6,000 out. So the IRS says, well, therefore, if you take $6,000 and move it to a Roth, only 50% of it is going to be tax-free. The other 50%, or $3,000, is going to be taxed. And you go, wait a minute, I've already paid tax, right? This is technically true because you're essentially taking 3 from here and 3 from here, and the IRS is just forcing you to pay tax on that. So it's not like you're getting taxed twice. Everybody falls for that. The IRS is just saying you can't pick only this $6,000. So they're not taxing you twice, but you have to take money out that then you pay taxes on. It's unfortunate, right? So what you want to do is, if you find that you are ineligible for a deduction in an IRA, get it out of there. Move it on. Right? Move it right away. We don't want years to go down the road and you go, wait a minute, 5 years ago, I didn't get my credit or my deduction on this. And then you end up owing, you only get to transfer so much and you have to pay tax. It's just, it gets to be a little bit of a mess there. So that is the traditional IRA mistake that I see most people make. It's a constant mistake because you don't check that. Nobody raises their hand and says, you're not going to get that deduction unless you have an accountant, CPA, whatever, and they happen to bring that to your attention. So something to pay attention to. I hope that helps you, by the way, and you enjoy the rest of your evening. The rest of your day. I just appreciate you guys watching. I hope that did help somebody out there. And look, you want to pay as little tax as possible. Bottom line, I don't want anybody paying any more tax than they need to. Hey, thank you so much for watching. Enjoy the rest of your evening. Hit the subscribe button if you would. Take a second and do that. We really appreciate that. And we'll talk with you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.